think that we remain in a state of heightened uncertainty. I would say obviously less so on the fiscal side now that the big beautiful bill has been passed, but the tariff and trade uncertainty is still with us. It's frozen the Federal Reserve. I mean, Jay Powell has already told us that he would be cutting interest rates right now if it weren't for the tariff file. I'm sure that's not a statement that Donald Trump would like to hear. And Powell has said that he's expecting there to be in the next few months a meaningful, he used the word meaningful, increase in inflation. So the Fed is frozen in time here. I think the longer they wait, the more they'll have to cut interest rates, and that might be more a story for the end of the year in 2026. But it's one of the things that also anchors my more bullish view on the bond market. We have a big disconnect here, right? Because when you look at the trailing PE multiple in the S&P 500, it's about at 26 right now. And yet, where you look mathematically to see where in the past has the S&P 500 traded in a period when real rates were this elevated, you're talking about a 17 multiple, not 25. So the stock market is being driven by sentiment, headlines, and animal spirits, and that can take you a long way, as we've seen already from the April lows. But I just don't like the mathematics. I don't like the fact that you have an equity risk premium basically back at zero. I think that's a massive anomaly that investors who are buying the stock market, and the latest Bank of America fund manager survey shows that risk appetite has just surged almost to unprecedented levels. But it's the math that I'm most concerned with, because when the ERP is zero, stock market participants are telling you that they believe that the S&P 500 is become a riskless asset class, that basically equities belong in the same risk bucket as Treasury bills and Treasury securities. And that just doesn't make a whole lot of sense to me. So we have a sentiment-driven rally, and the U.S. equity market is simply just too expensive for me right now, especially relative to the risk-free interest rates. So that's the bottom line as far as I see it related to stocks. The other thing I would just say is this. People will say to me, well, you know, the S&P 500 is telling you that the economy is going to be ripping to the high side. But what's driving the stock market are really these mega cap tech names, $4 trillion names that are growth stocks, which means they are the longest duration stocks, and nobody's buying Nvidia, for example, because of the view on the economic cycle. They're basically capitalizing Nvidia over 10 or 20 years. These are the longest duration stocks in the market. When you go to the Russell 2000, or you go to the S&P 600 and you look at what small caps are doing, they're still in correction mode. I mean, they've come off the lows, but they are still in correction mode. But we're fixated by the S&P 500, which has really become a large cap growth index. If you want to find out what the market's really telling you about the economy, look at the radical underperformance of the small cap stocks. They are the economy. And they're also very sensitive to these elevated interest rates, given their relatively poor balance sheet quality. So the small caps are actually giving me, I trace this back to the bond market. The small caps are telling me that the economy is cooling off dramatically, and also that interest rates are too high. And that will be resolved whenever the point that the Fed starts to get more visibility once the tariff file is behind us. Maybe that's 3 or 6 months away, we'll see. But I still believe that the next big move in interest rates, and this again is the counter trend view against the consensus, the next big move in rates is going to be lower, not higher. You know, the way that the big beautiful bill was constructed, it provides about net a half-point real GDP growth boost to next year. And it was designed to do that just in time for the 2026 midterm elections. Go figure that one out. And then it's restraint after that. You see all the good stuff happens first on the personal side, child tax credits and no tax on tips and overtime, Social Security, accelerated depreciation allowances, but the spending restraint kicks in later on. So actually, when you're taking a look at the whole 10-year period from the big beautiful bill, believe it or not, even with the hump that you're going to get, the hump, bump, and jump for 2026, over the entire 10-year period, fiscal policy is actually moderately contractionary. So that's a minus sign. The demographics, well, clearly, you know, the deportations, the immigration curbs, you're already seeing it play out in the decline of the labor force participation rate. Civilian population growth in the United States is now running below 0.6% at an annual rate. So all those people talking about, you know, the demographic thrust and the population boom and all the immigrants boosting growth, that's in the rearview mirror. So you're looking at not just the aging demographics amongst the native-born foreign population. And the fact that fertility rates and birth rates for the domestic resident population are at historic lows, you also got the immigration file. So the United States is gingerly following Japan. China already followed Japan. So population dynamics are squarely to the downside as far as GDP growth is concerned. From an inflation standpoint, what's going to matter is it going to have a bigger impact on the demand side, especially because immigrants tend to spend 100% of their incomes and they're also renters. So all of a sudden, landlords are going to be faced with even higher vacancy rates. At the same time, you're going to have a more depleted labor force, so that could mean that you get some wage pressures. There'll be a tug of war there. But demographics, fiscal, if you're talking about the next 10 years, they will at the margin be drags on real GDP growth. And then we've got the situation, of course, on the trade side. If the tariffs go as Trump says they're going to go, and we'll see what happens August 1st, you're talking about at least a $2,000 per household income squeeze. Right there, that's almost a full % off of GDP growth. Now, that's not necessarily going to be sustained over the next 10 years. And remember that these tariffs are not law. They weren't passed by Congress. But that's still going to be a state of affairs that we're going to have to contend with at least over the next year. Productivity, I mean, who knows? AI is supposedly generative AI and all the proliferation of all these data centers. And this is going to be a game changer for productivity, robotics, so on and so forth. When you look at the population profile for the next decade, and especially in the segment of the population, we're going to have a population boom amongst retiring baby boomers. The key is going to be what's the growth rate amongst the working age population. That is going to practically stagnate. So we are going to need to have a lot of productivity growth to offset those negative demographic factors. I believe that, look, if this is the internet on steroids, and we know what the internet did to productivity, then there probably is going to be a secular shift towards higher productivity. The question is by how much? The question is going to be, what does it do to output? Because the one thing we do know is that AI is going to be a job destroyer in a lot of industries, especially middle management, and as opposed to previous technological innovations that had an impact on, say, blue-collar manufacturing workers, this is going to be a deadweight drag on workers in the service sector, which is a much bigger chunk of the economy. So you can get a lot of productivity if output just stagnates, but you get a big decline in employment. Of course, we don't count robots in the employment numbers. So it's unclear really how the productivity is going to play out. People talk about productivity growth as if it's a phenomenal thing. I'm not going to say it's not, but you can get booming productivity if real GDP just stays flat, but you get a decline in the employment base. So the question is, will generative AI create the conditions for productivity growth that leads to not just labor cost savings, but also more output growth, the denominator? So that's going to be the critical question going forward. Inflation didn't go negative, and that's because it was a very sluggish process of the declines that we saw in residential rents morphing into the actual CPI data. That's actually only in the past few months that lag has started to play out. And so you're seeing, for example, the service sector is now slowing down precipitously at a time when you're seeing some moderate inflation in the goods sector. And of course, services are 60% of the CPI. So we didn't end up going negative, but let's face facts, okay? You had a lot of people talking about runaway inflation. You had people, okay, when I was saying that, talking about a return of the 1970s, okay? So the bigger call was that inflation had peaked and was going to come down precipitously, which it did. Our models had suggested that with the lags, the rental components were going to act as a big drag on the headline numbers, and that didn't materialize. So back to that point, that's because the shelter components were just so much slower to morph from what's happening in the real world in terms of rents to the CPI data. And now we've got a situation where we're going to have a hiccup on the goods side. You could say partly due to the weaker dollar, that is transitory, and from the tariffs. The question for the tariffs will be, as I said before, how much gets eaten in margins, how much shows up in final prices. And then if it shows up in final prices, if wages don't respond, then that leads to negative real work-based pay, which has about 100% correlation with real consumption, which is about 70% of GDP. So what happens with all this is you get a hump, but 12 months from now, inflation and core inflation probably are going to be lower with the tariffs. The price level will be higher, but the rates of inflation probably are lower a year from now than they are today. There was a time, when gold was $2,000 an ounce and I was saying it's going to break above $3,000 that I was viewed as a lunatic, but that's already happened. And now I think a lot of people have jumped on the bullion bandwagon. I like to focus on assets that are detested and maligned and underowned, misunderstood, and when there's a mispricing between what the markets are saying and what my crystal ball is saying. So I actually like the US Treasury market right now. I like where it's trading relative to the rest of the world. I like the fact that, at a 5% nominal yield on the long bond, you're pressing right up against the ceiling that we've been at for the better part of the past quarter century. And maybe it'll be different this time, I'm not sure, but that's always been a very good entry point for extending duration. Our bond duration model, by the way, notwithstanding the hiccup that we've seen in market rates, our bond duration model, our proprietary model, is actually flashing a buy signal for long-dated treasuries. And when I tell that to people, they either fall off their chair or they just almost faint. They can't believe it. But the real interest rate at the long end of the curve is 2.65%. That is very juicy. I understand that there are obvious risks towards being long duration right now, especially with all the tariff and inflation uncertainty. But the real yield right now is so high. In fact, it's not been this high at any other time in the past 15 years. A lot of that risk on fiscal, on inflation, on tariffs, on the tight labor market, that is already in the price. That is already in the price of the long bond, and therefore I'm comfortable being there right now in the 30-year Treasury bond, and that is probably right now my most out of consensus contrarian call.